Yes, very good evening everyone. Welcome you all to another session of CA Intermediate Cost Accounting Revision session. And today we have a very important session coming up that is on standard costing. Considered to be one of the tough chapters of costing, but let's quickly revise this chapter and make it easy. Okay, so join in quickly. I'll update in the WhatsApp also that we are now live. Okay, so let's see all those who are coming up live. Please let me know if audio video is clear, guys. Please confirm once that audio and video is clear. Yes, all those who are joining in live, please let me know if audio video is clear. So, good evening. So we have an important session on standard costing coming up. As I updated yesterday also that we'll be revising all the concepts of standard costing. We'll be discussing what all is standard costing. All clear, fine. So all those who are coming live, please like the video. Please hit the like button also. So we'll be discussing what all about standard costing is, then material variances, labor variances, then overhead variances, and especially the fixed overhead variances, right? The fixed overhead variances, I'll do one question also that I do in the batch. That question will do because fixed overhead variances is normally something that creates trouble for the students. So that will definitely take up. Okay, so we'll wait for 1 more minute so that more students can join in for the standard costing part. I think more will be interested in doing standard costing, isn't it? Because that is considered, this chapter is particularly considered to be one of the toughest ones. So we'll make it easy. We'll try and make it easy. All clear, fine. So you can share it with your friends also in the WhatsApp group and all anyone who wishes to join for standard costing. You have started from anywhere, doesn't matter. You'll be able to understand standard costing. So we'll be going into the details of this chapter, right? What all it deals with, how to deal with it. And for the questions part, for the ICI module part, I'll upload the complete ICI module part of standard costing on YouTube. In a day or two, I'll upload it. Right, and Vedant, I'll share your PDF. I remember I'll share your PDF after the class, right? I'll share the PDF to you after the class. Okay, so I think we are good to go. Let's start with the session. So first and the foremost thing, we'll see what all standard costing deals with, what standard costing talks about. Standard costing, or it is also known as what, or also known as variance analysis. Also known as variance analysis. Now, what this chapter deals with, the most important thing is you should know what this chapter deals with. Variance analysis or standard costing. if you analyze your real life also, in the real life on the daily basis, if you see, you plan a lot of things, but do you actually, you are able to execute each and everything what you have planned for? Normally not, right? So the difference between what you planned and what actually happened, that is what we call it as a variance, right? Similarly, the business also plans a lot of things. They plan what should be the raw material cost, they plan what should be the labor cost, they plan what should be the other expenses, but actually the cost may be more than the planning or less than the planning, isn't it? So cost may vary, the actuals may vary from the standard. So that variation is what we study in the standard costing or the variance analysis. That is what we study here, right? So what we say here is that what is the standard costing, also known as variance analysis, right? And deals with finding out the differences between standards and the actuals. Standards is what? It is your planned part, and the difference between the plannings and the actuals. Let's take a very simple example from your part. From your life only we'll take an example. Right? Let's say you are planning for any subject. You are planning for accounts, right? And what you are planning is, for accounts, obviously we make the plan, sir. Yes, sir. You are planning that you will cover 3 chapters in 3 hours. This is what? This is your thought process. This is what you have planned for. But actually, this might vary. Actually, what happened? You covered 3 chapters in 5 hours. Why, sir? Because there was a distraction. There was an Instagram reel sent by the friend. So you opened the reel, and when you opened the reel, after that you started scrolling with the reels. There was a guest arriving at the home. So you were able to complete these 3 chapters in 5 hours. So this 2 hours is what? This 2 hours is your variance. So this is exactly what business wants to know, that whether there is a difference between the planned cost and the actual cost. If there is a difference, that is what we call it as variance. Then they need to find out the reasons for the difference. Then if there is a difference, why there is a difference, right? You need to sort out those differences, because if you are thinking that your cost should be 10,000 but your actual cost turns out to be 20,000, so this is a huge difference. So they want to know that why there is a difference of this 10,000 rupees. Clear? This is the purpose of studying this chapter, that we call it as standard costing, that what you planned, what actually happened, and what is the difference between the planning and what actually happened. That is what we call it as variance analysis. This 2 hours is the variance here, right? Now, another very important thing in this, let's take this same example, that for accounts, you are doing some planning part, right? What is your plan? Your plan is to cover 3 chapters in 3 hours, right? This is your plan. But what you actually did is you covered 4 chapters in 5 hours. You covered 4 chapters in 5 hours. Now here, can you say that 2 hours is your variance? 2 hours is your variance. Can you say? No, sir. Now here we cannot specify that this 2 hours is my variance. We can't say that, right? So these are what? These are your standards, right? And these are what? The actuals. But here you cannot compare your standards with the actuals. You cannot compare it. The reason being, standards were set for 3 chapters, but actually the output is something different. You have done 4 chapters. So you cannot say there is a 2 hours of variance because you have covered more chapters, right? So in this case, this 3 chapters, this is called as standard output. This is called as standard output, right? And this 4 chapters is what we call it as actual output. This is what we call it as actual output. So this is your standard output and this is your actual output. So what should be done here? Standards were done for a separate output actuals are different. So in this case, what you have to do, you cannot change your actuals. Whatever you have actually done, can you change that? No. But what you can change is your thought process you can change, isn't it? So you will change what? You will change your standards. So what you will prepare now? Now you will set the standards. Now you will set standards for 4 chapters. So how will you set? For 3 chapters, if it is 3 hours, so for 4 chapters, your standard should be 4 hours. Now you can compare that for 4 chapters, your actual is 5 hours. This 1 hour is actually my variance. Right? This is my variance. So this part is what we call it as. This part we call it as standards. We are revising the standards for actual output. Standards for actual output, right? Sir, why can't we change the actuals? Actual is what actually has happened, but you can change your thought process. So standards we can change, but actuals we cannot change. So this thing you have to remember. Clear? This thing you have to remember. So you will change the standards according to the actual output. Now this is a very, very, very important part of it. Is this clear, guys? First, let me know this much. If this part is clear, this is a very important part for any of the variance calculation. This is a very important part. So if this is clear, please let me know. Yes, please let me know if this is clear, guys. Quickly. Clear? Okay. So now, when we talk about variance, variance can be 2 ways. The variance can be either adverse or it can be favorable, right? When we talk about this word variance, right? When we are saying this word variance, so variance can be 2 ways. Either it can go adverse, right? Or this variance can be favorable. It can be adverse or it can be favorable. What is an adverse variance? Adverse variance is you planned for. What is your standards? Your standard is that 3 chapters to be covered in 3 hours. Right? But what actually happened is actuals is 3 chapters in 5 hours. So this is your adverse variance. So we call it as A. Adverse variance is denoted by A. That is a negative value. That is a negative value. If we talk about in terms of cost, you thought about that there will be a cost of 10,000, but your actual cost is 15,000. So whether it is good or bad, it is not good, right? So here we will call it as a adverse variance, right? Then favorable is what? Favorable is when you are setting the standards that you will cover 3 chapters in 3 hours. But in actuals, you are able to cover these 3 chapters in 2.5 hours. Right, so this is a favorable variance which is denoted by F. That is a positive value. You thought that your cost will be 10,000, but your actual cost was 8,000. So that's a good thing, right? Your planned cost is 10,000, but your actual cost is how much? 8,000 only. So that's a good thing, sir. That is your favorable variance. But here one thing we say, that your standards should be realistic. That is very, very important. Now it is very much related to their real life. When you are planning for the preparation of any subject, when you are planning for something, make sure that your planning is realistic. Now if you say that accounts or costing or any subject, we will cover 3 chapters in 15 minutes or 3 chapters in half an hour. Is it realistic? That is absolutely not realistic. Then if you compare it with the actuals, actually you are taking 3 hours to complete. Now you say there is a variance of 2.5 hours. Is that a correct variance? No, that is not a correct variance, right? So your variances should always be realistic. That you always have to remember, right? Your variance should be, your standards should be realistic. Is it clear? This much is clear? Now the standards will always be set before the start of process and the actuals will be after the completion of process. That is where the comparison will come, right? That is where the comparison will come, that what we planned before doing the work and after completing the work, what actually happened. That is where the variance will come. The variance can be adverse, variance can be favorable, both ways it can be there, right? So now I'll move on to the individual variances. Now in the costing, we have three types of variance. Now variance is all related to cost here, right? That what is the cost you planned, what is actual cost that is being incurred. So it is being related to three parts. One, we'll talk about the material cost, right? Second, we'll talk about the labor cost. And third, we'll talk about overheads cost. Third, we'll talk about overheads. In the overheads, we'll talk about variable overheads. And we will talk about fixed overheads. So these two things we are going to talk about: material, labor and overheads. In the overheads, we'll be talking about variable overheads and fixed overheads. So we'll start with the first set, that is material variances. Are we ready, guys? Just let me know in the comment section, write down ready, so we can start with our first set, that is material variances. Yes, ready everyone? So when we talk about material variance here, what are the material variance here? Which material we are talking about? We are talking about, sir, raw material, right? We are talking about raw material. Now in the raw material cost, right? Raw material cost, the variance can be because of two reasons. One is quantity. One reason is your quantity and another reason is your price. Why the raw material cost can be different than what you planned for? One reason is you have consumed more quantity than you planned for or less quantity than you planned for. Another thing is you have got the raw material at a different price than what you planned for. So there can be two reasons for the difference. One is your price and another one is quantity. Clear? First and the foremost thing. Then when we are using the word, here two words we'll be using. One word that we'll be using is quantity. So when we are using the word quantity, we are talking about what? We are talking about raw material quantity. We are talking about raw material quantity, right? Second thing that we'll use is output. Output is what? This is your finished goods quantity. Whenever we are using the word output, that means we are talking about what? We are talking about finished goods. So it will be your finished goods quantity, right? So be careful with these two words. Do not get confused with the words that if it is quantity, it is raw material quantity, and if it is output, then it is your finished goods output. Right? So now, I've given you that material variance can be for two reasons. One is price reason, another one is the quantity reason, right? So this is the table that we normally prepare. Now, as I told you that comparison should be, okay, I'll take one very simple small example here. Let's say you planned for your standard output. Standard output is what you are planning to make. Output means here FG. You planned for 100 units. You planned for 100 units and you are saying that raw material cost per unit will be 5 rupees. Right? Will be 5 rupees. Then what is your actual output? Actual output means what actually you manufactured. You actually manufactured 150 units. You actually manufactured 150 units and your actual cost your actual cost turned out to be rupees 800. Now, can you compare? Here the raw material cost is 500, what you planned for. Can you compare this 500 with 800? This 500 is your standard cost, right? Because what you planned for, that we will manufacture 100 units. 5 rupees per unit will be the raw material cost. So 500 is the total raw material cost. But actual raw material cost is 800. So can you say that there is a variance of 300 rupees here? Can we say that? No, sir. We cannot say that here there is a variance of 300. Why? Because the standards were set for 100 units, whereas the actual number of units produced is 150. Right? So what you will have to do? Now you will have to set standards for actual output of 150 units. How will you set, sir? So what we can say that for 100 units, the cost is 500. So for 150 units, what will be the standard cost? Right? So here the standard cost will be 150 into 5, that is 750. Right? This is what we call it as this much. Standard quantity for actual output, that whatever you have actually manufactured, whatever is the actual output that you have manufactured, what is the standard quantity for that? Right? What is the standard quantity for actual output? What is the standard price? And this will give you the standard cost for actual output. Then the actuals will be there. Actual quantity, actual price, and actual cost is already there. Right? Revised standard quantity, I'll come to that later on. But for now, you need to understand standard quantity for actual output. The comparison between the standards and the actuals can be done only if both are for actual output. I'm repeating it again. If you want to write it down, I'll repeat it again. What I'm saying is the comparison between the standards and the actuals for variance analysis can be done only if the standards and actuals are for the actual output. That is why we are calculating the standard quantity for actual output. Right? So I've given the terminologies here. SQ for AQ. AO means standard quantity for actual output. Standard price, standard cost for actual output, actual quantity, actual price, actual cost, and revised standard quantity. First of all, tell me this part. Is this table clear that what this table actually denotes? What is standard quantity for actual output? This is very important for you people to understand that what exactly is standard quantity for actual output. Why we are calculating. Is this part clear? I'll repeat that line again. You must write it down. That the comparison between the standards and actuals, that is what we have to do in standard costing. The comparison between the standards and the actuals can be done only if both standards and actuals are for the same output. Same output means actual output. Right? Please confirm me this much if this is clear. Then we will go to the variances part. Right? Then we will go to the variance part. Yes, I'm waiting for your response if this is clear, guys. Then we will move to the variance part, that what all variances are there in the material. Standard quantity by standard price into actual quantity. Standard quantity by standard price. Standard quantity by standard price will not give you anything, Vedant. Standard quantity by standard price will give you what? Standard quantity for actual output is what? For I'm saying my standard output is what? My standard output is 100 units. This is what I'm planning to manufacture, right? Raw material consumption per unit is, let's say 2 units. That for manufacturing 1 unit of finished good, 2 units of the raw material will be required, right? But my actual output is 120 units, right? So my actual cost is incurred for how many units? My actual cost is incurred for 120 units. So I have to set the standards. Now standards for actual output will be how much? That will be 2 for every 1 unit. So actual output is 120 units. So 2 into 120, that is 240 units. This is my standard quantity for actual output. Right? If you have standards for 1 unit, then you can directly multiply it with actual output. Or you can do is standard quantity divided by standard output into actual output, not actual quantity. The formula that you have given is, Vedant, I'll change that formula. That is standard quantity divided by standard output into actual output. This you can say standard quantity for actual output. Is it clear? This we can say standard quantity for actual output. Yes. Is it clear, Vedant? Okay. Okay. So we have our first variance. The first variance is direct material cost variance. Right? So the cost variance is standard cost minus the actual cost. Clear? Fine. So cost variance is standard cost minus actual cost. Right? So why, sir, standard cost should be in the front and actual cost should be at the other part on the other side? See, what should be more? What should be more? That should be in the beginning. Your standards should be high, right? If you are saying your standard cost is what you planned for. You planned for that the expense will be 100, but actual is 90 rupees. Only then there is a 10 rupees of favorable variance, right? Otherwise, if we say that 100 minus actual is 110, then it will be 10 adverse. So what we are saying is that standards should be more, actuals should be less, then it will be beneficial. So we are keeping the standards in the front minus the actuals, what you planned for. Anyhow, the other way also, if you think the standards, first you will set the standards, then you will compare it with the actuals. So if you see it in terms of benefit, your standard benefit will be, if your standards are more, your actuals are less, then it will be beneficial. So we keep the standards in the beginning minus the actuals. Tarang, this is the new one only going on. You have seen a very old video, right? And for the marks, what matters most is how you attempted, right? That matters more. We can't say that revision was not correct. That revision was a super quick revision that was just for 1.5 days. This revision, this is already the new revision we are doing, right? In Hindi, I'm not sure whether I'll take or not as of now, but this is simple English that everyone can follow, right? So if you are scoring 35 on that, first you have to see what you have written in it. That's more important. Right? So you should see first, you should get your copies and you should analyze what you have written. It can be because of the silly mistakes, isn't it? Yes, this is for January 27. The same is applicable because in costing there are no changes. Right? So the same one is applicable for January 27 also. So the direct material cost variance is done. Then direct material price variance. Now we say for the actual quantity that you have purchased, what is the difference? What is the difference because of price? Right? So we take price variance as standard price minus actual price into actual quantity. Right? So what is the meaning here? That for actual quantity purchased or consumed, what is the difference? What is the difference because of price? Right? What is the difference because of the price? Right? So that is your direct material price variance. Then in this direct material price variance, one thing I would like to mention. Sir, there can be two things. Okay. For this actual quantity, there can be two things which are given. For this actual quantity, you might be given the actual quantity consumed, right? Or it is given actual quantity purchased. For the variance part, what we should take? For the variance part, we'll take the actual quantity consumed. Right? For the variance part, you have to take the actual quantity consumed, not the purchased one. The purchased one might be given because for the calculation of actual rate. But normally when we are talking about the variance, the price variance, we will take it on the actual quantity that we have consumed, not the one which is lying in the store. Right? Now, next, third one is direct material quantity or usage variance. Right? Now here the price doesn't have a role. Keeping the price is constant, that is a standard price. What is the difference in the material cost due to the quantity? Due to quantity, that is standard quantity for actual output minus actual quantity into standard price. Right? Here the price will not change. The difference is why there is a difference because of the quantity. Standard quantity for actual output minus actual quantity into standard price. Right? So this is your quantity variance. Now, as I told you that direct material cost variance, the difference can be due to price or the difference can be due to quantity. So cost variance is equal to price variance plus quantity variance. So this condition will normally hold true, and from this you can check whether your variance calculation is correct or not. Right? So cost variance, price variance and quantity. Now price variance, here you have to be careful that for the price variance we use actual quantity, because what we are saying is for the actual quantity that we have consumed, what is the difference due to the price? Right? In the quantity variance, what we say that for the price that what we have thought, we are not saying the price will change. For the price that we have thought, what actually will be the difference because of the quantity consumption? Because of the quantity consumption. So here we take standard price. Are the first three variances clear? Is the first three variants clear? Now this condition will not hold true. This will not hold true if you take actual quantity purchased in price variance. Right? This will not be true if you are taking actual quantity purchased in material price variance. I'm telling you this. So do not search for it that I'm calculating using the actual quantity purchased and this condition is not holding true. It will not hold true. It will hold true only if you are taking the actual quantity consumed. Clear? Okay, first tell me if the cost, price and quantity or usage variance is clear. Then I will move on to the next one. We have two more variants in this. The sub variances we have. So we have two sub variances. Okay, so now in the quantity variance, I have two subvariants. In the quantity variance, I have two subvariants. But those subvariants are applicable only if there are two or more than two raw materials are being used. Right? When I talk about direct material, quantity or usage variance. In this, I have two sub-variants which are there. One is called as direct material mix variance. One is called as direct material mix variance. Direct material mix variance. And the another one is called as direct material yield variance. Another one is direct material yield variance. Right? Direct material mix variance and direct material yield variance. Now, mix variance says what? The mix variance says, now these are applicable if two or more than two or more than two raw materials are being used. Right? So this is applicable if two or more than two raw materials are being used to manufacture a finished product. Clear? So direct material mix variance says there will be a difference in the quantity usage if you are mixing the wrong quantity of raw material. Right? Let's say there are two raw material A and B. Those two raw materials are to be mixed in the ratio of 4:3, but you mix it in the ratio of 3:4. Right? Both the raw materials will have the different prices. Clear? So it will change. So your quantity changes means there is a direct material quantity variance. So direct material, this variance says what? That inappropriate raw material mix used. Inappropriate raw material mix used. Right? If a raw material is to be used in the ratio of 4:3, you use it in the ratio of 3:4. Obviously, the quantities that you are consuming will be different, then there will be a variance in the quantity consumption. Right? The second that we are having is direct material yield variance. Now, what is this direct material yield variance? Direct material yield variance says inadequate yield. Inadequate yield or inadequate productivity. Yield or inadequate productivity of input. Right? Wait, Vedant, I'll tell that. Inadequate yield or inadequate productivity of input. Now, what does it mean? It means that you have set the standards according to you in the 100 kg of raw material. 100 kg of raw material, you will be able to manufacture 100 units. That is what is your thought process. Right? Here, when we are talking about the word yield, this word yield means the output. This word yield means the output. Right? So inadequate yield or the inadequate productivity of input. Standard is 100 kg of raw material, 100 units. But what actually happened is, actuals is, in 100 kg of raw material, you are able to manufacture only 80 units. So what we are saying, inadequate output. Sir, here there is no difference in the raw material quantity. Yes, there is no difference in the raw material quantity, but in the same raw material quantity, you are getting a lesser output. So if you want to manufacture 100 units, right? If you want to manufacture 100 units, you will need more than 100 kg of. You will need more than 100 kg of raw material. Is that clear? So obviously, when you need now more than 100 kg, this will lead to your quantity variance, right? Okay, so you are asking about the FM revision. See, for FM, I don't think I'll be able to take up the revision, right? Because my throat is still not that good to take up the revisions regular basis. Costing was committed, so I'm just completing the costing part, right? But I have a perfect solution for FM. I have a detailed revision series. Detailed revision series of FM is already available, which was conducted, I think last year I conducted it. That playlist I'll share with you. Right? In English, it is complete available. All chapters in detail I have covered in detail. Right? So that is quite a comprehensive FM, this revision that is available. For costing, that comprehensive revision was somewhere missing. So that is why I started with the costing part. For FM, I have a detailed revision that is already available. And there is no change in that. There is absolutely no change in that. Had my throat been in a very good condition, I would have taken the FM also live. I was actually willing to take FM live, but the problem is I'm saving it. My face-to-face batch is going on in the morning. So I'm saving little bit of it for the morning thing. Still, if I feel like after maybe 10 days, if I get a time, I might go in for one day revision shot. One day revision shot, we'll see. But I'm not committing anything that will go for it. That revision playlist, if you want, I'll share it at the end of the class. I'll share that playlist link. Right, from where you can do the financial management complete detailed revision. In Hindi, English, both it is available. In Hindi, I think 1 or 2 chapters are not available, but in English, all the chapters are available. Right? So this is your quantity variance, mix variance and yield variance. Now, in case of mix and yield variance, what is there? How your table will look like, right? So I'm going into the table part now. Standard quantity for actual output, this is same. Standard price, standard cost. Actual quantity, actual price and actual cost. Then we have revised standard quantity. Then we have revised standard quantity. Right? Now let's say you are mixing 2 raw materials. Let's say you want to make some dish. For that dish, you need to use potatoes. And you need to use the flour. Now your standard quantity, what you have planned for is using 80 grams of potatoes and 20 grams of flour. That is total 100 grams of raw material at whatever the price it is, 0.01, 0.02, right? So your standard cost will be 0.8 and 0.4. But actually, what actually your worker did, your worker made it 70 grams and 30 grams. That is, he used total of, 70 and 10 grams, not 30 grams. Total of 80 grams he used and manufactured the product. Price, let's keep it simple and straightforward, 0.2. Right? Now, he has made the same dish in 80 grams. You taste it, you find that dish is fine and it's good, no? If the same thing can be manufactured in 80 grams instead of 100 grams, you can manufacture more number of units, isn't it? But then you gave the idea, you said, okay, you have used 80 grams, that's fine, but we can improve the quality of that dish by using what? By using 80 grams, that's fine. That same example. But I don't want to elaborate on that example here. So you are like, okay, fine, 80 grams, use 80 grams, but the proportion matters, no? The taste will change if there is little bit of more chili or it is less chili, isn't it? The taste will change. So you are like, okay, use 80 grams, no problem. But use it in this proportion. Instead of 7:1, use it in the proportion of 8:2. Use it in the proportion of 8:2. That is, this will give you 64 and this will give you 60. This is what we call it as revised standard quantity. So what is this revised standard quantity? RSQ is what? RSQ is actual quantity consumed. It is actual quantity consumed, right, to be divided in the ratio of standard quantity for actual output, right? So this is your revised standard quantity, the total actual quantity divided in the ratio of standard quantity for actual output. This is what is there, right? So based on this, we have direct material yield variance, right? Yes, that was this Lalaji example. This exactly, you have identified it correct. This example was famous as a Lalaji example. The standard costing revolves around this example itself. The Lalaji example, the famous Lalaji example, right? So you people remember it, this chapter as a Lalaji chapter. So what is your direct material yield variance? Now what will happen? Yield is output. So what do you say? You say that if you change your approach, your thought process, this is your original thought process. If you change it to this thought process, what will happen? You can have more yield, right? If you change your approach, your original thought process, change it to the revised thought process, your yield will increase. So yield variance is what? Yield variance is standard quantity for actual output minus revised standard quantity into standard price. So this is your direct material yield variance. Now what is your mix variance? What is your mix variance? Direct material mix variance is what? That according to your revised thought process, what should be the mixture minus what actually you have mixed into standard price, right? So yield means output. The output will change only if you will change your thought process, right? So we then change the thought process from original to the new thought process. Mix is what? Now according to your changed thought process, what should be the mixture and what actually the mixture is into standard price. And this yield and mix variance can be calculated only and only if there is more than one raw material being used. So this you have to be very careful with. Is this clear, everyone? Is this clear? Yes. All the material variances are clear. Please let me know. Yes, clear. Okay, so if you are clear with the material variances, so you can say that labor variances are now easy. Now, one thing very common that you will find in the material questions is what they say, that there is a certain input that you have done. There is a certain input that you have done. They'll not give you the input, right? They'll not give you the input. For the input, they will give you the standard ratio. They'll give you the standard ratio. That is, let's say there is raw material A which will be 60% and raw material B which will be 40%, right? Then it is given that normal loss of 10% of input, right? That whatever you input, there will normally be a loss of 10% on that input. then you are given the actual output. Let's say the actual output is given as 1700 units. Right? In this case, this is the common type of question. This is one of the most important questions that you will find from standard costing. Right? Illustration 3, I think it is there. So in this case, what do you have to do? You have to find out this total standard quantity for actual output. Right? What will be your standard quantity? Standard quantity for actual output. What will be that? What will be your standard quantity for actual output? What will be that? Now, what we are saying is that if you input X, right, on that input, you must have got a 10% loss. Then you have got 1700 units as the actual output. So what is the standard input for the actual output of 1700 units? That is 1700 divided by 90%. So it will come to 1889, right? Some odd figure is coming. That's fine. I've just taken an example, random example only, right? So this becomes your total standard quantity for actual output. Now this you will divide in the ratio of 60% and 40% between A and B. Clear? So this information you will find in many questions. Is this clear, guys? This part is important, right? So with this, we are done with our material variances. We are done with the material variances. After this, we'll move to the labor variances. Now, material variances, if you are able to understand, then labor variances are very, very easy. Right? So next we have is, after material variances, what we have is labor variances. Next we have is labor variances. Now, in case of labor variances, what we are saying, we are trying to find out the variance in the labor cost. Now, in labor cost, what can be the reasons for the variance? In the labor cost, what can be the reasons for the variance? There can be two reasons. One is your labor hours. That means your worker has spent more time than you have estimated. Then obviously you will have to pay for more time. The second reason can be the labor rate. Right? That your worker is charging more rate than you have expected. So it can be two reasons. One is your labor hours and another one is your labor rate. So this can be the two reasons for the labor cost. Again, we'll calculate the same thing. Now for labor variances, again we'll calculate standard hours for actual output. Obviously, again the same line, that the standards can be compared with the actuals only and only if it is for the same output. So we calculate that for the actual output that is manufactured, according to our plan, what should have been the standards? What should be the time that should have been spent? So standard hours for actual output, standard rate, and then standard cost. Then actuals are given to you. Actual hours is actually how much time he has taken for that actual output, actual rate and actual cost. Right? So standard hours for actual output, standard rate, standard cost for actual output, actual hours, actual rate, actual cost, and revised standard hours. Now this revised standard hours we will take only if there is more than one type of labor. More than one type of labor is employed. Right? Like we have skilled labor, semi-skilled labor, unskilled labor. So if we have more than one type of labor employed, in that case, we will have the revised standard hours. Same, on the same lines, we have the direct labor cost variance, that is standard cost for actual output minus actual cost. Again, we will keep the standard cost upfront because standard cost should be more than the actual cost. Then labor rate variances for the actual hours paid. What is the difference? because of the rate that is being given, standard rate minus actual rate. Clear? Then efficiency variance is standard hours for actual output minus actual hours worked into standard rate. Right? Efficiency shows that what is the number of hours you have planned for, what actually he has worked. Same, okay, same it will be for standard hours for actual output. You can take, let's say, your standard output. Okay, your standard output is 100 units. Standard output means what you planned for the finished goods. You planned that you will make 100 units of the finished goods, right? Then labor hours per unit. That for every 1 unit, the labor hours is, let's say, 2 hours to manufacture 1 unit. Now, if your actual output, so that means the total labor hours here is 200 hours. Now, if your actual output is, let's say, 120 units. So what will you do here? What will you do here? Now you want to calculate the standards for actual output. So that will be total standard hours divided by standard output multiplied by actual output. Total standard hour here is 200 divided by 100 into 120. So that will give you 240. Right? So this is your standard hours for actual output. So if the standards are given already for 1 unit, directly multiplied with actual output. Directly multiplied with actual output, you will get the standard hours for actual output. Simple. Clear? Now, here one thing we need to focus on. What is that, sir? If you see, I've used 2 words here. I've used 2 different words here. If you have noticed. If you have noticed, I've used 2 different words here. Here I'm saying the actual hours paid, right? Okay, I'll zoom it. Oh, too much. Actual hours paid, and in the efficiency, I'm saying actual hours worked. Actual hours worked. Standard hours for actual means whatever is the actual output, calculate what is the standard hour for every 1 unit. Right? Simple. Calculate what is the standard for every 1 unit multiplied with the actual output. Right? This way you can remember just one thing. Calculate the standard time to be taken. Standard time for every 1 unit. Then multiplied with actual output. You can remember is this way. Clear? Now, there are 2 things I'm saying. The actual hours paid and the actual hours worked for. What is the difference here? What is the difference here? Let's say a worker comes in your factory. A worker is coming to your factory and the worker is spending 8 hours in your factory. Right? A worker is working for total hours in a day that he is spending is 8 hours. Right? In a day, he's spending 8 hours in your factory. Just imagine, can he work for continuous 8 hours? Can he work for continuous 8 hours? That is practically not possible. So what will you say? There will be a certain idle time. He will need idle time is what? He will need time for lunch, for tea, coffee break. He will need time for that. Let's say 1 hour is your idle time. So actually is working for 7 hours. Now, are you going to deduct money because he's having food? Are you going to deduct money for this 1 hour? No, right? So this is your actual hours worked. And this is your actual hours paid. If there is a difference between actual hours paid and actual hours worked, then the rate variance is what is the rate that you are paying. So it will be on the basis of actual hours paid. See here, The rate variance I am calculating on the basis of actual hours paid. But the efficiency of the worker, the efficiency is what you thought, that how many hours he can work and what actually he is working, right? So that will be on the basis of actual hours worked. That is why efficiency is on the basis of actual hours worked. The difference will be only if the idle time is given in the question. Only and only if the idle time is given in the question. So cost variance is because of either the rate or efficiency. But this line is very important, that if the hours paid and worked are different, then this will not hold true. Right? If your hours paid and hours worked is different, then this will not hold true. Then your cost variance will not be equal to your rate and efficiency variance. Right? This you have to remember. So this is your cost and rate and efficiency variance. Now, efficiency variance is further divided into mix and yield variance on the same lines. Right? On the same lines, that mix variance is what? Inappropriate mix. Means for the work that you are doing, you should be having more of skilled labor, but there you employed more of unskilled labor. That case also there will be a problem. Yes, sir. So mix and yield variance. Yield variance aims, you need to change your thought process. Standard hours for actual output minus revised standard hours into standard rate. Mix variance is according to your changed approach, what should be the mixture, that is revised standard hours minus what actually is the mixture into standard rate. Then there is one more variance here, that is called as idle time variance, that is idle hours into standard rate. Idle hours will be there into standard rate, and idle time variance always adverse. This is always adverse. Obviously idle time variance, you are paying for that variance, but you are not getting actual output in that. So it will always be an adverse variance, right? So do not search for that in the idle time, whether we should write favorable or whether we should write adverse. It will always be an adverse variance, right? The idle time variance will always be a adverse variance. Is it clear, guys? Yes, please let me know about the labor variances. Let me know about labor variances. Yes, please let me know if it is clear. All clear? Okay. Now, one thing more you need to remember while doing the practical questions. It's a very small point, but yes, it's a relevant point that I wanted to share. Small. Yield means the output. Yield means the output. See, here I have written that yield word. Yield means what? The yield means output. Right? So here what we are saying, just try to understand here. If the same thing can be made in the lesser raw material, right? Earlier you were making one sandwich with 100 grams. Now you can make one sandwich with 80 grams. So you can manufacture more sandwiches with 80 grams. I'll upload tomorrow. I'll upload the ICI module questions of this standard costing. Yes, I will upload it. For standard costing, I'll upload the complete chapter of ICI module series, right? Because I've made all the tables and all in that. So I'll upload the complete chapter for that. Tomorrow I'll upload. I'll just combine all the videos. I'll upload as a single short video, right? Tomorrow morning, most likely I'll upload. Okay, Prachi, is it clear? Same. Yield in case of labor also, it means the output only. If you change the labor composition, If you change the composition, if you employ more of skilled labor, in the less in the less wages, in the less hours you can manufacture more, right? In case of labor, how the yield can be impacted? If you employ more of skilled labor, then in less number of hours you can manufacture more units. That is how the yield can be impacted. Yes, is it clear, Prachi? Please confirm once if it is clear. Done? Okay, fine. Now, there is one small point that I wanted to tell you here. In case of price variance, in case of material, or rate variance in case of labor, right? Let's say you make a table and let's take the price variance, right? Direct material price variance, that is standard price minus actual price into actual quantity, right? Here, if this actual price is coming in decimal, it is coming in decimal. For example, standard price is 10, whereas actual price is coming out to be 8.87543 and so on into actual quantity of 100 units. If this is the case, in that case, what you should do not leave this standard price in decimal. What you should do is, you should open it like this. You should open this bracket like standard price into actual quantity minus actual price into actual quantity, right? This actual price into actual quantity now is what? Standard price you are having 10 into 100 minus actual price into actual quantity will give you actual cost. So take the total value of the actual cost. If you take it in the decimals like this, if you round it off to 2 decimal or 3 decimal, then there will be a difference in your answer. So let's not give the paper checker any chance to deduct the marks, right? Because of this decimal also, we don't want to give that chance to the paper checker to deduct our marks. So if that is the case, where the price, the actual price per unit is coming out to be in decimals, do it like this, right? Open the bracket, actual cost will be a round off figure only. That is not a case. It will be a round off figure only, right? So this is one thing where you need to be careful, right? Be careful with this thing. It might not be wrong. Otherwise, if you take it in decimals, if you are rounding it off to 2 decimals or 3 decimals, otherwise it will not be wrong. But why to give paper checker any chance to deduct our marks? We don't want to give, right? So these small things will matter in the exam. Okay, coming to the next part now. Next part we have is overhead variances. Next part is overhead variances. Overhead variances. Now, overhead variances, we have two things. One is variable overheads and another is fixed overheads. Now, as you know, we have already studied in the chapter of overheads that these are to be absorbed, right? These are to be absorbed, and in standard costing, when we will be absorbing the overheads, we will normally be absorbing on the basis of labor hours. We will normally be absorbing on the basis of labor hours, right? So we will normally be absorbing it on the basis of labor hours. Now, how we calculate the absorption rate here? How we calculate absorption rate? If you remember, the absorption rate we calculate is overhead absorption rate is budgeted overheads is what? Budgeted overheads divided by budgeted. If we want to do it on the labor hours, then it will be budgeted labor hours, isn't it? Budgeted labor hours. So let's say your budgeted overheads is 1 lakh, your budgeted labor hours are 10,000. So what you are getting is rupees 10. So absorption rate is what? It is your standard rate, as it is being calculated on what? It is being calculated on the budgeted data. So it is your budgeted rate or the standard rate. Clear? Now if you want to calculate your absorbed overheads, absorbed overheads will be what? Absorbed overheads will be absorption rate, that is standard rate, multiplied by actual hours, actual into absorption rate. That is what we do, isn't it? So when we are making the table of this variable overhead variances, normally absorbed on the basis of labor hours, that is what I have written. Now if you are doing it on the basis of labor hours, the table will be same as for the labor hours. Standard hours for actual output, standard rate, standard cost, actual hours, actual rate, and actual cost. There will be no revised standard thing. Will there be any revised standard hours? Absolutely no. That is only in case of material and labor variance, right? So here this much will be the table. Standard hours for actual output, standard rate, standard cost. Now here this standard rate represents what? This standard rate represents your absorption rate. This standard rate represents what? Your absorption rate, right? And when you are applying this absorption rate to the actuals, because the standard hours are calculated for what? The standard hours are calculated for the actual output. So when you are applying this standard rate to the actuals, what you will get? This standard cost is what you call it as absorbed overheads. Absorbed overheads. And this is what, sir? This is your actual rate. Actual hours. This is your actual rate, and this is your actual cost, actual overheads. Now, if there is a difference between the absorbed overheads and the actual overheads, what we can get it from here? Under or over absorption. Although here we will not discuss about under and over absorption, just as we have done it in the chapter of overheads. Clear? So standard rate represents what? This represents your absorption rate. Standard cost represents what? It represents your absorbed overheads. Because if this kind of a question comes in the MCQ, they might use the word absorbed overhead. Absorbed overheads, if they are giving the word absorbed overhead, that should immediately strike your mind. The absorbed overhead means this part, standard cost for actual output. Right? So it should immediately strike your mind that what they are actually talking about. Clear? So in case of variable overhead cost variance, same. So there are three only: cost variance, rate, and efficiency variance. Here overhead expenditure variance also they say. Instead of rate, we use the word expenditure variance also. Right? So standard cost for actual output, here standard rate minus actual rate into actual hours, and efficiency is standard hours for actual output minus actual hours into standard rate. Right, so here for variable overheads, there is no hustle bustle, simple straightforward things. Simple straightforward things we are having. Is this clear? Variable overheads clear? So variable overheads is pretty easy. There is not much to be discussed in the variable overheads. Now we'll move to the fixed overheads part. Yes, variable overhead variance is clear. Please confirm once, then we will move on to the last part, that is our fixed overhead variances. Clear? Okay, now coming to the fixed overhead variances. This is a bit trickier part, isn't it? This is a bit trickier part, that what should be done in case of the fixed overhead variances. Okay. Now, in case of fixed overhead variance, what we have to do? Again, these are to be absorbed on the basis of labor hours. The same table till here, same table as the variable overheads, but here we are adding one more thing, that is budgeted hours, budgeted rate, and budgeted cost. Now what is this? Otherwise, if you say, sir, budgets and standards mean the one and the same thing, isn't it? Budgets and the standards, they mean the same thing. So what is the difference between this standards and this budget? The only difference is these budgets are what? These are the standards. These are my standards for standard output. These are my standards for standard output. Sir, what about these then? These are the standards. These are the standards for actual output. So this is the difference between the two, right? That this is the overheads budgeted. This part represents what? The budgeted cost or the budgeted fixed overheads according to the originally planned output. What you originally planned for. Actual output can be different than what you planned for. Like we have been taking that 100 units is what we planned for, but actually it turned out to be 150 units. So this budgeted hours, budgeted rate and budgeted cost, it is for 100 units, right? It is for 100 units. Clear? And normally when we are talking about the fixed overhead quotient, we normally start from this part. First we'll fill up this, second we'll fill up this, third we'll fill up actual hours, actual rate and actual cost. Normally we'll start the quotient with budgeted data. The budgeted data will normally be given in the quotient itself, right? So budgeted hours, budgeted rate and budgeted cost. Clear? Now there are many formulas for this. 3 plus 2, 5 plus 2, 7. 7 formulas are there. Cost variance, same. Standard cost for actual output minus actual cost. No change in the cost variance. Cost variance remains the same for all, right? Then fixed overhead budget variance. Budget variance is what you originally planned for. What you originally planned for. What is the budget that you have set and what actually happened? So it is the budgeted cost minus actual cost. If I say in Hindi, it is क्या सोच कर गए थे और क्या करके आए. So budgeted cost represents whatever you planned for. Actual cost is what actually happened. So budgeted cost minus actual cost. That is your budget variance. Sorry, that is your budget variance. It is also called as expenditure variance, sir. It is also called as expenditure variance. So if it is expenditure variance, it is the budget variance only, right? Also called as expenditure variance. Now, fixed overhead volume variance. Volume variance is what? The volume means the output. Oh, sir, if the output changes, output means the finished goods output, right? If the output changes, what is the first impact? What is the first thing that you will have to do? The first thing is you will have to change your standards. So that means the volume variance is the comparison between the standards only. Standard cost for actual output minus budgeted cost, right? With the change in the level, with the change in the volume, with the change in the output, what is to be changed? The standards are to be changed, right? The standards are to be changed. So cost variance is equal to budget variance plus volume variance. Clear? So remember this way. Now the volume variance says why there is a change in the volume. That means output. There can be two reasons. One is efficiency of the worker. Second is the capacity of the worker. Efficiency variance is same. That is standard hours for actual output minus actual hours into standard rate. Now capacity variance is what? The capacity variance is you have underestimated or overestimated the capacity. What is the budgeted hours? You thought that the worker will work for 5 hours only. He actually worked for 8 hours. Now what is good? What is good? Actual hours. Having more of actual hours is good here. So we'll keeping actual hours minus budgeted hours into standard rate. What you thought? You thought that the worker will work for 5 hours. That is your budgeted hours. But the actual worker worked for 9 hours. Now what is good, sir? The good is he's working more. Right? Working more means that is why we are keeping the actuals here. Actuals in front, then the budgeted. That is your capacity variance. Now if he is working beyond the capacity, then there will be change in the output. Or if he is more efficient, in the same time he is working more, he is manufacturing more number of units, then also there will be a change in the output. Output means the volume. your volume will change because of two reasons. Either because of efficiency, that in the same time or in the lesser time he is able to manufacture more. Second is if he is working beyond his capacity, right? So these can be the two reasons for the change in the volume. First tell me if these first 5 are clear. Then I will move to the revised capacity variance, calendar variance and revised capacity variance. First tell me if these two are clear. Yes, clear. Okay. So now let's talk about something about the capacity variance, from where we have to find out this calendar and revised capacity. Let's talk about this part. What is there? Sir, you calculated the fixed overhead capacity variance. Yes, sir. Fixed overhead capacity variance we have calculated. For fixed overhead capacity variance, the city will vary. I didn't get it. Fixed overhead capacity variance is what? Actual hours minus budgeted hours into standard rate, right? This is what you are doing. Yes, sir. This is what we are doing. Now, let's say you are given actual hours is 40 hours. The budgeted hours is 35 hours. Now, you will be very happy. You thought that the worker will work for 35 hours, but he's actually working for 40 hours. Right? But when you analyzed it further, these standards were set for 25 days. Whereas actually he is working for 27 days. Now can you compare this actual and the budget and say he's working efficiently? Can you do it? No. Right? This is your actual days. This is your actual days and this is your budgeted days. Now, can you compare? No, sir, we cannot compare. So what should be done? Sir, now, can you change this actual hours? No, the actuals you can never change. But what you can change is your budgets, right? So here we will again So here what we will do, here we will calculate now the budgeted hours for actual number of days, right? So that we call it as possible hours. Possible hours is what? The budgeted hours for actual number of days, right? Budgeted hours for actual number of days. How will you calculate that? Sir, for 25 days, that is your budgeted days, your budgeted hours is 35 hours. Now, for actual days, that is 27 days, what is your budgeted hours? That is 35 by 25 into 27. So that will come to 38 hours. Now you will compare this 38 hours with 40 hours to calculate your capacity variance. So that is what we call it as revised capacity. See here, the revised capacity variance, that is actual hours minus, instead of budgeted hours, we will use possible hours into standard rate. And there is one more variance that we do, that is called as calendar variance. Calendar variance is possible hours minus budgeted hours. That because of the change, calendar shows what? The calendar shows the number of days. Because of the change in the number of days, you have to change your budgets, right? So what is the change? Because of the change in the number of days that is working. So possible hours minus budgeted hours into standard rate. That is your calendar variance. So possible hours is the standard hours for actual number of days. Calendar and revised capacity variance can be calculated only if standard and actual working days are given in the question. Right? So if the working days are not given, then you cannot calculate calendar and revised capacity variance. In case of fixed overhead variance, try to start the question with budgeted data. That is what I've told you earlier also. Is this clear, guys? This possible hours part is clear? For calendar and revised variance, is this possible hours part clear? Yes. So with this, we are done with all the variances. We are done with all the variances. So in standard costing, one of the most important things will be if you are able to frame the table, right? The table that we have been making, if you are able to complete the values in the table, then nothing will be difficult. The only tricky part is that you are able to find out the correct values for the table, right? If you are able to do that, everything is sorted, right? So if you have studied from somewhere else, everyone might not be using the table, I don't know. This table approach, definitely I follow this table approach. So if you are doing it by any other approach, totally fine, no issues. The table preparation is not important from examination point of view, right? So I follow the table approach. That is why I've told you, if you have started from somewhere else, you're just revising it from here, that's totally fine. The table approach, I find it comparatively easier to explain and understand. So that is why I follow this approach. Okay, any doubts in this, guys? Any doubts in the fixed overhead part? Yes, any doubts in this? Please let me know. No doubts? So all of you have done that one question that we have done in the lectures with this, right? If you have done that question, that's fine. So tomorrow I'll upload. So I'll not take up that question again, right? What I'll do is tomorrow I will upload all the ICI module questions of standard costing. For this specific chapter, I will upload all the questions, right? Because for this particular chapter, we have followed is like, even if the table is not there, we have prepared the table for it. Now I'll give you one thing, right? So I'll end the today's session here itself. All the conceptual part of standard costing is done. What I will do is I will do one thing, that is I will give you that financial management playlist, right? Just give me 2 minutes so that I can give you the financial management playlist link. And please do cover the case studies. I've already uploaded all the module case studies of financial management as well as cost accounting. Yes, financial management revision. Wait, let me check. And I have uploaded one FM, this plan also, which is very good. I've done a hard work on that plan. So you must, if you can follow that plan, that will be really good for you, right? So last year I uploaded, so English and Hindi, both the videos are there, right? And these are, I'm telling you, these are detailed videos, guys. 1 hour working capital and yes, 2 hours I've spent on working capital only, 40 minutes on cash management, 1 hour on receivables management. So, okay, fine. I'll share this playlist with you. 1 second. Financial management revision. Sure. I'm sending this. I'm sending in the next 1 hour, Vedant. That's what I told you after the class. I'm sending you. Right. This is your FM playlist, FM revision playlist. Right. I'll put it in the pinned comments also. Financial management revision playlist. I'll put it in the pinned comments also. Right. So I'll do that. Okay, any doubts in the today's session, or we'll close this session? Right, this is your FM playlist that I have put. I'll put the same link in the pinned comments of this video also. So financial management detailed revision, you can do it from this. All the concepts revision, you can do it from this for sure. Yes, any doubts in this, please let me know. All clear? Right. So tomorrow we'll take up marginal costing. 7 o'clock we'll do. We'll cover marginal costing, and if the time is there, I'll just go through with the budgetary also. Marginal costing we'll do. Right. I'll tell you what kind of questions are there in the marginal costing. Then we'll do marginal versus absorption. That cost statement also we'll do. Right. Full CA intercourse means? For costing at FM, I'm already having full courses. Regular batches are there. For costing at FM, it is there. Regular batches are there where I've gotten with the detailed one. Or you're saying for all the subjects? All subjects. Yes, that is, I can make it available. In Hindi, I can make it available because at my face-to-face academy, we are providing all the subjects. At the face-to-face academy at my place in Ludhiana, we are having a face-to-face academy, right? That is at the TCA Academy, Toppers Commerce Academy. So there we teach all the subjects, full CA foundation, full CA intermediate, all subjects we are covering. But I can't teach all the subjects now. I will teach only where I have the specialization. In Punjab, in Ludhiana, Punjab, we have the face-to-face academy here, where we take face-to-face classes. Yes, I know the book was there. You're from Kanpur or something, Vedant? I know. No, online also are there if you want for the other subject, but there are other teachers, not me. I'm just taking costing and FM there also. Other faculties are there. Is taking accounts is being taken by CA Shivam sir. Then tax law, audit and SM is being taken by Raghav sir. Okay, yes, you are from Kanpur, right? So we have all the subjects, online recorded videos we have. Okay, let's, okay, fine, done for the today's session, right? So see you guys tomorrow, 7 o'clock we'll meet. We'll do the marginal costing detailed revision. Then we will move to budgetary, and then we will move to service costing, right? So that's what the plan is. CMA costing for paper 8. Ankit, for paper 8, yes, you can cover the playlist which is there on the YouTube. I'm not currently having any paid course for the CMA, but the costing playlist which is available on YouTube, that is 100% applicable for paper 8. You can cover all the topics for paper 8 from there. Along with that, you can follow the revision series. For CMA, there is an exclusive revision that was done. Right, so you can follow that revision series along with that. That will be 100% preparation for your paper 8. Right, Ankit? For paper 8, you can follow that strategy. That's what our CMA students are following. YouTube playlist plus the revision playlist. That revision is exclusively for CMA, paper 8. Where I have covered those cost accounting standards also. Yes, any other question? (2023) 23 playlist you are following now. Ankit, please follow the 2023 playlist, not the old playlist. Right? If you are following that playlist, good enough. For paper 8, that will be fine. Along with that, just follow the revision series. That's it. More than enough. Rest is your question practice. And do share with your friends also. Anyone who is preparing for CMA or CA, you can share that playlist with your friends also. Right? Okay, so we are done for today, I guess. Yes, we are done for today. Done. So see you guys tomorrow, 7 o'clock with marginal costing, right? So see you guys till then. Stay safe, stay healthy, keep studying, keep sharing. Thank you so much.